All right, so get ready because today we're diving deep into something I know you've been curious about, the impact of U.S. monetary policy on emerging markets.
Yeah,
You've sent over some really interesting research.
it's a fascinating area.
Yeah, focusing on how effective those prudential policies are in shielding economies from the aftershocks.
Yes, it is.
Yeah,
We often think of economies operating independently, but in reality, they're deeply intertwined.
right.
What the U.S. Federal Reserve does can ripple across the globe,
Yeah.
impacting countries thousands of miles away.
Right. And just to be clear for our listener, when we talk about these prudential policies in emerging markets, think things like capital requirements that banks have to meet,
Yeah.
or even limits on how much people can borrow for a mortgage,
Exact.
sort of like economic safeguards.
Precisely. And you specifically want to look at how these policies play out in emerging markets, which we'll call EMs from here on out.
Okay.
There are a lot of them to keep track of.
Yeah.
The research suggests they might be more important than we initially thought.
Okay, so let's get into it. What makes EMs so vulnerable to U.S. monetary policy decisions in the first place? They have their own central banks, right?
They do. But there's this relatively recent discovery in economics called the global financial cycle.
Okay.
Essentially, capital flows, asset prices, and credit growth are highly synchronized across the world.
Wow.
Think of it like a giant interconnected financial ecosystem.
A financial ecosystem, that's a great visual.
Yeah.
So where does the U.S. fit into all of this?
Think of the U.S., or really the U.S. Federal Reserve, as the conductor of this global orchestra.
I like it.
When the Fed changes interest rates, it sets off a chain reaction impacting financial conditions globally.
Okay.
That's the global financial cycle at work.
So even though EMs have their own central banks and unique economic landscapes, they can't escape these global waves.
Exactly. They are inevitably caught up in those currents. And that brings us to the heart of your question.
Right.
Do those prudential policies act as effective shock absorbers? Can they help EMs maintain some control amidst these powerful global forces?
Okay, so that leads to the big question, do these policies actually work? Does the research back that up?
One study looked at 29 EMs over 2 decades, and the findings are compelling.
Okay.
It turns out that prudential policies can indeed offset the negative impacts when the U.S. tightens its monetary policy.
Interesting.
Yeah.
So it's not a case of EMs being helpless bystanders.
Yeah.
They actually have tools to fight back, so to speak.
Right. They can use prudential policies strategically to maintain a degree of control, even when the Fed is making moves that could destabilize them.
Okay, I'm hooked. Tell me more. Which of these prudential tools are the most effective? I have to imagine the research digs into that.
It does, and 2 stand out.
Okay.
Reserve requirements and limits on loan-to-value ratios, also known as LTV ratios for mortgages.
I'm all ears. Could you break down how each of those work in simple terms?
Of course, reserve requirements essentially force banks to keep a certain percentage of their deposits in reserve instead of lending it all out.
Okay.
This creates a buffer. Now imagine the U.S. lowers interest rates to stimulate its economy.
Okay.
Suddenly, it's cheap to borrow money, and that cheap credit can flow across borders.
Ah, I see where this is going. Suddenly, EM banks are tempted to lend out more money because everyone wants in on the action.
Exactly. But those reserve requirements act like a counterbalance. EM banks can't go on a wild lending spree, even when the global tide is pushing them that way.
It's like taking the punch bowl away before the party gets too wild.
A perfect analogy. And the research shows this can have a real impact on dampening the effects of U.S. monetary policy on EM credit markets.
Interesting.
It helps to prevent a credit bubble in those emerging markets.
Okay, so that's reserve requirements. What about these LTV limits?
LTV limits come into play when we talk about the housing market.
Okay.
They put a cap on how much money people can borrow against a property.
Yeah.
So even if interest rates are low, people can't get in over their heads.
So it helps prevent runaway housing bubbles fueled by easy credit coming from the U.S.
Exactly. Think about what happened during the U.S. housing boom in the early 2000s.
Yes.
Easy credit inflated a bubble that ultimately burst.
Yeah.
LTV limits can act as a safeguard against similar scenarios in EMs.
That makes a lot of sense. I'm starting to see how these seemingly technical policies play a huge role in global economics.
They absolutely do, and it becomes even more critical when we consider the bigger picture and what these cycles can mean, not just for a country's GDP,
Okay.
but for its overall financial health.
Okay, well, now you really have me on the edge of my seat. Let's dive into that bigger picture. What are we missing when we just focus on GDP and inflation?
Here's where it gets really interesting.
Okay.
Traditional economic indicators like GDP growth and inflation might not tell the whole story when it comes to financial stability.
Okay.
Think of them like a snapshot of the economy at a moment in time.
So they're like looking at a single frame from a movie.
Exactly.
You get a glimpse, but you don't see the whole plot.
We need to understand the whole movie,
Yeah.
the entire economic cycle. There's a lot happening beneath the surface that traditional indicators might miss.
Okay, now I'm really intrigued. What's lurking beneath the surface that we need to be aware of?
Well, think back to the 2008 financial crisis.
Mm-hmm.
The warning signs were there, but not always obvious if you just looked at GDP and inflation.
Right.
What we've learned since then is that crises rooted in too much borrowing and asset bubbles are different.
Okay.
They're called balance sheet recessions.
Balance sheet recessions. So
Right.
it's not just the overall economy that's struggling, it's the balance sheets of individuals, businesses, even governments. Everyone is over-leveraged.
You got it.
Oh.
It's a situation where everyone is trying to deleverage at the same time, and that downward spiral is hard to escape.
Right.
It impacts the entire financial system.
And this connects back to the financial cycle, how I'm starting to see the pieces come together, but I need help connecting them.
Failing to understand these financial cycles and how long they can last can lead to policies that solve short-term problems but create bigger ones down the line.
Okay.
The U.S. experience in the 1980s and 2000s is a perfect example.
Can you elaborate on that? I know a bit about those periods, but help me connect those events to this idea of financial cycles.
In both cases, the U.S. faced economic slowdowns.
Right.
So policymakers did what they usually do, lowered interest rates to encourage borrowing and spending.
Right. Classic economic stimulus, get things moving again.
Exactly. And it worked in the short term, but it also contributed to those imbalances we talked about.
Right.
Excessive credit growth, inflated asset prices, that sort of thing.
So they addressed the immediate problem, but at what cost? It sounds like they were just kicking the can down the road.
You could say that eventually those imbalances became unsustainable.
Yeah.
In the 1980s, it led to the savings and loan crisis, and in the 2000s, the global financial crisis.
That's a pretty powerful illustration of how overlooking those financial cycles can backfire. Are there other examples of this happening globally?
Absolutely. It's a pattern that has played out in many countries. The takeaway is that policymakers need to take a long-term view. Short-term fixes can sometimes create much bigger problems down the line.
So I'm hearing that it's crucial to understand these financial cycles, not just for policymakers, but for anyone making financial decisions.
You are absolutely right. And that's where things get really interesting for our listener. This isn't just theoretical.
Yeah.
It has real implications for everyday decisions.
Okay, I'm ready for part 2. I need to know how all of this impacts me and what I can do about it.
Well, then let's dive into that.
All right, so we've established that understanding these financial cycles is critical not just for countries, but for individuals like our listener too.
Yeah.
But how can we actually use this information to make better decisions?
Well, think of it this way. Imagine our listener is considering buying a house.
Okay.
Being aware of where we are in the financial cycle, are interest rates really low? Are housing prices skyrocketing? Can help them assess the risks involved?
Okay, so it's not just about finding a house you love and getting a mortgage.
Right.
You need to factor in the bigger economic picture too.
Precisely. Let's say you buy a house at the peak of a housing bubble, fueled by cheap credit. What happens when that bubble bursts? Suddenly you could be underwater on your mortgage.
Right.
Understanding the financial cycle can help you avoid those pitfalls.
So it's about being a savvy consumer of economic information, not just blindly following the crowd or getting caught up in the excitement.
Right? Take the stock market, for example. We've seen periods of irrational exuberance like the dot-com bubble in the late 1990s.
Yeah.
Everyone was piling into tech stocks. But when the bubble burst, many people lost a lot of money.
That's a great point. Understanding the financial cycle can help you make more rational decisions, even when everyone around you seems to be losing their minds.
Exactly. It's about taking a step back, assessing the broader context, and not letting emotions drive your financial decisions.
This is really practical advice now. I want to go back to something you mentioned earlier, those specific prudential policies that can help countries navigate these global financial waves.
Right.
We talked about reserve requirements and LTD limits. Are there other tools in the policy toolkit?
Yes, there are. The research you provided actually delves into the effectiveness of a whole range of prudential tools.
Okay.
One that caught my eye is something called sectoral capital buffers.
Okay, that sounds pretty technical. Break it down for me. What are sectoral capital buffers?
Imagine like this, regulators identify specific sectors of the economy that are considered riskier than others.
Okay.
Maybe it's real estate lending or consumer credit.
Yeah.
They then require banks to hold extra capital against loans in those specific sectors.
So it's like a targeted reserve requirement.
Exactly.
You're shoring up the weakest links in the chain.
It helps to prevent excessive lending in those areas that could create systemic problems if things go south.
That makes sense. What other tools are out there?
Another interesting one is limits on bank concentration ratios.
Yeah.
This is all about preventing banks from becoming too exposed to a single borrower or group of borrowers.
So if a major company goes bankrupt, it doesn't take down the entire banking system with it.
Precisely, diversification is key in finance.
Yeah.
It's about spreading the risk.
Right. Don't put all your eggs in one basket.
Right.
What about this idea of restrictions on interbank exposures? I think you touched upon this earlier.
Yes, this is a crucial one. Remember, banks constantly borrow and lend money to each other.
Right.
But if those interbank exposures get out of hand, it can create a domino effect. If one bank fails,
Yeah.
it can trigger a cascade of failures throughout the entire system.
It's like that too big to fail problem, but it's the entire banking network that's too interconnected to fail.
You've got it. So by limiting these interbank exposures,
Yeah.
regulators can reduce the risk of that kind of systemic meltdown.
Okay, so we've got a whole arsenal of prudential tools to address these issues, but I have to imagine it's not a one-size-fits-all approach. Different countries must use different strategies, right?
Absolutely. The research actually provides some really interesting insights into how various countries have implemented these prudential policies.
Oh.
For example, Peru and Nigeria were very proactive in tightening their policies in the lead up to the 2008 financial crisis.
I wonder if that helped them weather the storm better than others.
It's definitely something to think about. It's not a perfect comparison, of course, but it's interesting to see how those countries that were more proactive fared compared to those that were less prepared.
Right, it seems like there are valuable lessons to be learned from studying how different countries navigated those tumultuous times.
There definitely are. And it's not just about looking at what worked well, but also what didn't work.
Okay, so let's talk about those potential downsides. I imagine no policy is perfect, and there are always trade-offs, right?
You are absolutely right. One concern is that prudential policies could stifle economic growth if they are too restrictive.
Yeah.
If you make it too difficult to borrow money, it can slow down investment and job creation.
So it's like a balancing act.
Yeah,
Too much restriction could choke off the economy, but too little could lead to those financial imbalances we talked about.
exactly. It's about finding that sweet spot.
Are there other potential downsides?
Well, some experts argue that these policies could push risky lending activities into the shadows, into those less regulated parts of the financial system. It's like squeezing a balloon. The air has to go somewhere.
That's a great analogy. So it's not just about implementing policies, but about monitoring them closely to see how they're actually playing out in the real world.
Precisely. And being willing to adjust those policies as needed.
You know, this whole discussion about prudential policies reminds me of something we talked about earlier, the idea that focusing solely on traditional economic indicators like GDP might not give us the full picture.
Right.
It seems like we need to be looking at a wider range of factors, right?
You are spot on, and that brings us back to this crucial concept of the financial cycle. It's not just about how fast the economy is growing today, but about understanding the underlying dynamics that are shaping that growth.
All right, let's unpack that some more. We talked about the financial cycle before, but how does it relate to these prudential policies?
Remember, the financial cycle tells us that economies move in cycles, not just in terms of GDP, but in terms of credit growth, asset prices, and risk appetite.
Okay.
Those cycles can be influenced by many factors, including, you guessed it, U.S. monetary policy.
Okay, so we have these cycles, and they're influenced by global forces like U.S. monetary policy, but how do prudential policies fit into all of this?
Prudential policies are, in many ways, designed to moderate the excesses of the financial cycle. Think of them like shock absorbers.
I like that.
When credit growth is running too hot, they can help to cool things down. When asset prices are getting out of control, they can help to bring things back down to earth.
Ah, I see. So they're not just about responding to crises, but about trying to prevent them from happening in the first place.
Exactly. It's about smoothing out those boom-bust cycles that can be so damaging to economies both in the short term and the long term.
It seems like policymakers have a tough job. They need to balance so many competing priorities.
They absolutely do, and it's not always easy to get it right.
Yeah.
But by understanding the financial cycle and having a good set of prudential tools at their disposal, they can increase the odds of success.
This has been incredibly insightful, but I'm curious to know for our listener, what is the key takeaway here? How can they apply this knowledge to their own lives?
The key takeaway is that understanding the financial cycle is empowering.
Yes.
It gives you a framework for making better decisions about your money, whether you're buying a house, investing in the stock market, or even just thinking about your long-term financial goals.
I love that it's about taking control of your financial future, not just being swept along by the currents.
Exactly.
Okay, we've covered a lot of ground here, but I know there's still more to unpack, especially when it comes to what happens when things go wrong.
You're right. We've talked about how to prevent crises, but the reality is sometimes they happen anyway.
Exactly.
Then,
I'm all ears. Let's dive into those crisis management and resolution strategies. All right, so we've talked about how prudential policies can act as preventative measures, helping to mitigate the risks of financial crises.
right.
But let's face it, sometimes those preventative measures aren't enough or they're not implemented effectively, and crises still happen. What then?
You're right. No system is perfect. And when those financial fires do erupt, we enter the realm of crisis management and crisis resolution. The research you provided actually delves into the differences between these two phases.
Okay, so there's a distinction between managing a crisis and actually resolving it. I'm guessing crisis management is about those immediate actions to contain the damage.
Exactly. Think of it like first aid for the financial system.
Okay.
You need to stop the bleeding, prevent a full-blown meltdown.
Mm.
Central banks often act as lenders of last resort, providing emergency liquidity to keep the system afloat.
So it's about stabilizing the patient, making sure the vital organs are still functioning, but then comes the longer-term process of healing and rebuilding, right? That's where crisis resolution comes in.
Precisely, crisis resolution is about addressing the root causes of the crisis.
Okay.
Those underlying imbalances that led to the crash in the first place. It's a much more complex and nuanced process.
It sounds like it requires a different set of tools and strategies. What are some of the key elements of effective crisis resolution? The research must offer some guidance.
It does. One of the papers highlights a fascinating case study, the Nordic banking crisis in the early 1990s. The Nordic countries, particularly Sweden and Finland, faced a severe banking crisis, not unlike what we saw in the U.S. in 2008.
Okay, I'm intrigued. What did they do differently that made their approach so successful?
They took a very decisive, comprehensive approach.
Okay.
First, they enforced loss recognition, meaning banks had to come clean about their bad loans, no more hiding the skeletons in the closet.
So they ripped off the bandage, so to speak, exposed the wound to allow it to heal properly.
Exactly. Then they recapitalized the banks that were still viable, often through temporary public ownership. They separated the good banks from the bad banks, creating what were called bad banks, to isolate those toxic assets.
That's interesting. It's like a triage system for the banking sector.
A great way to think about it. And finally, they streamlined their financial systems, reducing excess capacity and promoting efficiency. They made those tough decisions up front, which ultimately led to a faster and more sustainable recovery.
It's like they took their medicine quickly, even though it tasted awful, and came out stronger on the other side.
Exactly. And their experience stands in stark contrast to what happened in Japan during the 1990s. They faced a similar banking crisis, but their approach was much more hesitant.
What happened in Japan? What made their experience different?
They were slower to recognize the extent of the problem and more reluctant to use public funds to address it.
Okay.
They delayed the painful process of cleaning up bank balance sheets, hoping things would somehow magically fix themselves.
So they kind of kicked the can down the road, hoping the problem would go away on its own?
That's one way to put it. The result was a prolonged period of economic stagnation, famously known as Japan's lost decade.
Wow, that's a cautionary tale. It seems like there's a clear lesson here. Swift and decisive action is crucial in these situations.
Absolutely. The longer you wait, the harder it becomes to fix the problem. Those wounds can fester and become even more difficult to heal.
Okay, so let's talk about the specific policy tools that governments can use in those crisis resolution phases. What options do they have?
The research points to three main areas: prudential policy, fiscal policy, and monetary policy.
Okay.
We've already discussed prudential policies quite a bit, but in a crisis resolution phase, those policies shift from preventing excessive risk-taking to encouraging lending to credit-worthy borrowers and restructuring debt.
So it's about getting the credit flowing again, but in a more sustainable way this time.
Precisely. Now, fiscal policy also plays a crucial role in those balance sheet recessions we talked about, where everyone is trying to reduce debt. Governments often need to step in and boost demand.
That makes sense. If everyone is cutting back, someone needs to be spending.
Right, and that someone is often, the government, they might increase spending on infrastructure projects, cut taxes to put more money in people's pockets, or even provide direct financial assistance to households.
I can see how that would help stimulate the economy, but wouldn't it increase government debt? That seems risky.
It can, but the research suggests that in those extreme situations, the risk of doing too little is far greater than the risk of doing too much. If a balance sheet recession spirals out of control, it can cause much more damage to the economy and lead to even higher debt levels down the road.
So it's a calculated risk you're accepting more debt in the short term to avoid a much worse outcome in the long term.
Exactly. It's like investing in a costly repair now to prevent a much more expensive replacement later on.
That's a great analogy. Okay, so we've covered prudential policy and fiscal policy. What about monetary policy? What role does the central bank play in all of this?
Central banks can play a crucial role by keeping interest rates low and providing liquidity to support the financial system. Think of it as providing life support to help the patient recover.
That makes sense, but doesn't that risk creating more debt and asset bubbles down the line? We talked earlier about how low interest rates can sometimes fuel those excesses.
It's a legitimate concern, and it's something policymakers grapple with constantly. But in the midst of a balance sheet recession, the more immediate concern is often deflation.
Deflation, that's when the prices fall, right?
Exactly. And while lower prices might sound good at first, deflation can be incredibly damaging to an economy. It encourages people to postpone spending, which weakens demand and can lead to a vicious cycle.
So it's a delicate balancing act you need to support the economy without setting the stage for the next crisis.
You've hit the nail on the head, and that brings us back to the importance of understanding those financial cycles. By recognizing where we are in the cycle, policymakers can make more informed decisions about how to use these policy tools effectively.
This has been an incredible deep dive. We've covered so much ground from the global financial cycle to prudential policies and crisis management. What are some key takeaways for our listener who's probably absorbing all of this information like a sponge?
I think the biggest takeaway is that knowledge is power. By understanding these complex economic forces, our listener can make more informed decisions both in their personal finances and as an engaged citizen.
That's a great point. It's about empowering ourselves to navigate these complex waters rather than feeling like we're just being tossed around by the waves.
Exactly, and I hope this deep dive has sparked a curiosity to continue exploring these topics. There's always more to learn, and the more we understand about the forces that shape our world, the better equipped we'll be to navigate them.
Well said. And on that note, I think we've reached the end of our deep dive, but I have a feeling this conversation will continue long after we sign off. Thank you for guiding us through this fascinating exploration.
It was my pleasure. Remember, the journey of discovery never ends.